Hi there, and welcome to the Retirement Wealth Podcast. We're so glad you're joining us today. You know, a lot of people think of retirement as just a time to relax and enjoy life, but it's also about making your money work for you, right?
Absolutely, Emily. And today we're diving into a really fascinating topic: how to generate cash flow from commercial real estate. It's something that can be a game changer for anyone looking to secure their financial future.
For sure. I mean, many retirees are looking for ways to supplement their income, and commercial real estate can offer some great opportunities. We'll talk about what that really looks like, the pros and cons, and some strategies to consider.
Right, and we'll also cover how to assess your risk tolerance and what to look for in a good investment. It's all about making informed decisions, especially when it comes to your retirement funds.
Exactly. And we'll share some real-life examples to help illustrate those points. You know, it can be a bit daunting to think about investing in commercial real estate, but with the right information, it can be an exciting avenue to explore.
And, as always, we want to make sure that you feel equipped to take those steps confidently. It's not just about the numbers, but also about creating a lifestyle you love in retirement.
So let's jump right into it. What should people consider first when thinking about generating cash flow from commercial real estate?
So, Emily, as we dive deeper into why generating cash flow from commercial real estate is really important right now, I think we have to acknowledge the current economic climate. You know, inflation has been a hot topic lately, and it's affecting everyone's retirement plans.
Absolutely, David. I mean, with prices rising, it can feel like our savings are losing value. It's like, how do you keep up with that?
Exactly. Take, for instance, a couple I spoke with recently. They had planned a comfortable retirement with a set amount of savings, but with inflation hovering around, 5 to 6%, their purchasing power has taken a hit. They were really worried about maintaining their lifestyle.
That's a tough situation. It must have been stressful for them.
It was, and that's where cash flow from commercial real estate comes into play. You know, real estate often appreciates over time, and rental income can provide a buffer against inflation. So while their savings seem to be shrinking, the cash flow from a well-chosen property can help keep pace with rising costs.
Right, and that's such a crucial point. It's not just about having money saved up. It's about making that money work for you.
Exactly. And speaking of making it work, we also have to think about market volatility. With stocks and bonds, the market can swing wildly. I had another client who was heavily invested in the stock market, and when the recent downturn hit, they felt like their whole retirement was on shaky ground.
Oh man, that sounds really unsettling.
It was. They realized they didn't have a diverse enough portfolio, but shifting some of their investments into commercial real estate helped them stabilize their income. It's like having a safety net when the market gets rocky.
Yeah, it sounds like a smart strategy. But what about tax efficiency? I know that can be a big concern for retirees too.
Great point. Real estate can offer some significant tax advantages. For instance, depreciation can offset rental income, which means you might pay less in taxes on that cash flow. I remember one retiree who was worried about their tax bracket. Once they started investing in real estate, their overall tax situation improved significantly.
That's a win-win, for sure. And it ties into legacy planning too, right?
Absolutely. When you think about passing down wealth to the next generation, owning commercial properties can provide a stable asset that appreciates over time. It's something tangible that your heirs can manage or sell, whereas, a fluctuating stock portfolio might not have the same certainty.
And let's not forget about Social Security changes. I mean, with all the discussion surrounding that, it's crucial for people to have additional income sources.
You bet. Social Security alone might not cover all your expenses, especially with healthcare costs rising. A client of mine, for example, was counting heavily on Social Security. But when we looked at their expenses, it was clear they'd need more. They decided to invest in commercial real estate, and now they have that additional cash flow to rely on.
That's really encouraging to hear. It's like they found a solution that not only meets their needs now, but also prepares them for the future.
Exactly. And speaking of healthcare, we can't ignore that. It's a significant expense in retirement. A survey I read recently showed that a couple retiring today might expect to spend over $300,000 on healthcare costs alone. That's a big number.
Wow. That's staggering. How does commercial real estate fit into that picture?
Well, having that steady cash flow can help cover those unexpected medical bills or long-term care. It's all about peace of mind, really. Knowing you have a consistent income can ease a lot of that financial anxiety.
Right. And when we talk about the emotional side of financial security, it's huge. I mean, that peace of mind is invaluable.
Yes, financial security can significantly impact how people feel about their retirement. I have clients who tell me they sleep better at night, knowing they have a diversified income stream. It's like lifting a weight off their shoulders.
It's amazing how much our financial situation can affect our overall well-being.
Absolutely. And when they have cash flow from real estate, they can enjoy their retirement more fully, whether it's traveling, spending time with family, or just pursuing hobbies.
So true. It's about living life on your terms, isn't it?
Exactly. And, with the current economic trends, it's becoming increasingly important to think creatively about income sources in retirement. With interest rates rising and inflation impacting savings, real estate can provide that reliable cash flow.
So it seems like a well-timed strategy for many folks out there.
Yes, and that's why we're seeing more retirees and pre-retirees explore commercial real estate as a viable option. It's not just about building wealth. It's about creating a sustainable income stream that aligns with their retirement goals.
This conversation really highlights how important it is to think ahead and consider all the factors at play, doesn't it?
Exactly, Emily. And with that in mind, let's transition into some core strategies for getting started with commercial real estate. So, Emily, when we think about generating cash flow from commercial real estate, it's really important to understand the fundamentals first. Like, the different types of commercial properties and how they can fit into a retirement portfolio.
Absolutely, David. I mean, there's retail, office spaces, industrial, and even multifamily units. Each of these has its own risk profile and cash flow potential, right?
Exactly. For instance, multifamily properties can often provide more consistent cash flow because people always need a place to live, whereas retail spaces, well, they can be more volatile, especially with the rise of e-commerce.
Yeah, that makes a lot of sense. So if someone is considering investing in commercial real estate, what's a good rule of thumb for cash flow?
A common guideline is the 1% rule. This suggests that a property should generate at least 1% of its purchase price in monthly rent. So if you buy a property for $200,000, you'd want to see at least $2,000 in monthly rental income.
That's a nice, simple way to look at it. But if you're looking at properties that don't quite hit that mark, what should investors consider?
Well, they might want to look at properties in growing areas or consider the potential for value-add opportunities. Like, maybe the property needs some renovations that could increase its rental income after the investment is made.
Right, so it's about seeing the bigger picture and understanding the potential for appreciation, too. Speaking of which, how does this fit into a broader retirement plan?
Good question. You'd want to make sure that your cash flow from real estate complements other income sources, like Social Security, pensions, and withdrawals from your retirement accounts. It's all about creating a diversified income stream.
And diversification is key, right? It's not just about having a mix of asset classes, but also where those assets are held, like in taxable accounts versus tax-advantaged accounts.
Exactly. Tax-advantaged accounts like 401ks and IRAs can help grow your retirement savings without immediate tax implications. But when you start withdrawing from them, you need to be mindful of RMDs, or required minimum distributions, which kick in at age 73.
Yes, and that can really impact your tax situation. It's like, if you're not careful, you could end up in a higher tax bracket just from those withdrawals.
Right, and that's where having a solid withdrawal strategy comes into play. The 4% rule is a popular guideline, suggesting you can withdraw 4% of your initial retirement portfolio each year, adjusted for inflation. But it's not one size fits all.
No, definitely not. Depending on market conditions and your personal situation, you might need to adjust that percentage. Some folks prefer a bucket strategy, where they segment their assets into different buckets based on when they'll need the money.
Yes, the first bucket could be for short-term needs, like cash or cash equivalents, while the next bucket could be invested in more stable, income-producing assets. And the last bucket could be for long-term growth, like stocks or real estate.
That's a great way to manage risk and ensure you have access to funds when you need them. But let's not forget about the role of bonds in this mix.
Absolutely. Bonds can provide a steady income stream, especially during market downturns. A traditional rule of thumb is to hold a percentage of bonds equal to your age. So if you're 60, you might have around 60% in bonds.
That's a good starting point, but again, it depends on your risk tolerance and overall financial goals.
Precisely. And when it comes to tax savings techniques, it's worth looking into strategies like tax loss harvesting, where you can offset gains with losses, or holding investments in tax-advantaged accounts to minimize your tax burden.
Those strategies can really help stretch your retirement dollars further. And speaking of stretching dollars, let's touch on annuities. They can be a useful tool for generating guaranteed income, right?
Yes, but they come with their own complexities. Fixed annuities can provide a stable income stream, while variable annuities have investment components that can grow, but also carry risk. It's essential to understand the fees and terms associated with them.
And that's where working with a financial advisor can really help, especially when navigating these options.
Exactly. They can help you align your financial plan with your retirement goals, ensuring you're not overly exposed to risk while also aiming for growth.
So, if someone is considering commercial real estate as part of their retirement strategy, they really need to think about how it fits into their entire financial picture.
Right. It's all interconnected. You can't just focus on one piece without considering how it impacts everything else.
And of course, there are common pitfalls to watch out for, like over-leveraging or not doing enough due diligence when purchasing a property.
Yes, it's crucial to conduct thorough research and understand the local market conditions.
And also, keeping an eye on property management. A property can generate cash flow, but if it's not managed well, that can eat into your profits.
Exactly. It's about being proactive and informed, and knowing when to seek help. That way, you can truly enjoy your retirement without financial stress.
Perfectly said, David. So as we wrap this up, I hope our listeners feel more empowered to explore cash flow strategies in their retirement planning.
Definitely. It's about making informed decisions and building a strategy that works for you.
And now, let's dive into those common pitfalls.
You know, Emily, one of the biggest pitfalls I see is the sequence of returns risk. It's this idea that the order in which you experience investment returns can really affect your retirement savings, especially if you start withdrawing money during a market downturn.
Right. So, if someone retires and then the market drops, they might be selling investments at a loss just to cover their living expenses?
Exactly. And that can really derail their retirement plans. I had a client not too long ago. Let's call him Tom. He retired in early 2020, right before the pandemic hit. The market dropped significantly, but he needed to draw income from his investments, which meant selling at a loss.
Oh no. How did that affect him in the long run?
Well, it took a toll. He had to adjust his withdrawals, and it meant that when the market rebounded, he wasn't able to fully capitalize on those gains because he had already depleted some of his principal. It's a tough lesson, and it highlights the importance of having a solid withdrawal strategy in place before you retire.
So what would you recommend to avoid that situation?
Diversification in both your investments and your withdrawal strategy. Having a mix of income sources can help cushion against those downturns. Also, keeping a cash reserve can ensure you don't have to sell assets at an inopportune time.
That makes total sense. What about taxes? I feel like that's another area where people can really trip up.
Absolutely. A lot of retirees underestimate the impact of taxes on their withdrawals. You know, they plan for their income needs, but don't consider how much will actually get taxed.
Right. Like if they're withdrawing from a traditional IRA or 401k, that can really add up.
Exactly. I had a couple, let's call them Lisa and John. They were withdrawing funds without factoring in their tax brackets. They ended up pushing themselves into a higher tax bracket, which meant they lost a chunk of their withdrawals to taxes. It's crucial to have a tax-efficient withdrawal strategy in place.
So how do you create that kind of strategy?
It starts with understanding your income sources and how each is taxed. For example, mixing taxable accounts with tax-deferred accounts can help manage your tax liability. Plus, some folks might consider withdrawing from their taxable accounts first to allow their tax-deferred accounts to grow longer.
That's really insightful. And then there's the whole healthcare and longevity issue, right?
Yes, that's a big one. Many people underestimate how long they might live and the healthcare costs that come with it. A lot of retirees don't prepare for long-term care expenses, thinking it won't happen to them.
I can see how that would be easy to overlook.
I had a client, let's call her Sarah. She was in great health and thought she wouldn't need long-term care. But, as luck would have it, she developed a health issue that required extensive care. She hadn't saved for it, and it put a strain on her finances.
That has to be so stressful.
It is, and it's not just the medical costs, it's the emotional toll as well. Planning for healthcare costs and including long-term care insurance in your strategy can really help mitigate that risk.
Definitely. And then there's asset allocation, right?
Yes, poor asset allocation is another common mistake. Many retirees become too conservative too quickly, thinking they need to protect their capital. But if they don't keep some growth-oriented investments, they're not keeping up with inflation over the long haul.
So they could be losing purchasing power?
Exactly. I had a retiree. Let's call him Mark. He moved all his investments into bonds because he was worried about the market volatility. But with inflation rising, his purchasing power started to erode.
That's a tough balance to strike. How do you advise clients on that?
It's important to maintain a balanced portfolio that aligns with their risk tolerance and long-term goals. It's also about regularly reviewing and adjusting the portfolio as life circumstances change.
And what about Social Security? I know a lot of people claim it too early.
That's a huge one. Claiming Social Security benefits early can reduce the monthly benefit significantly. I had a client, let's call her Mary. She claimed at 62, thinking she'd get a head start on the income. But she didn't realize how much that would impact her benefits over her lifetime.
Wow! What did she do when she realized?
Well, it was tough for her. She had to adjust her spending in retirement because her monthly benefit was lower than she anticipated. I always encourage clients to think about their full financial picture before making that decision.
So it's about having a plan and understanding the long-term implications.
Exactly. By evaluating when to claim benefits alongside other income sources, retirees can make a much more informed decision that supports their lifestyle and longevity.
Those are some really helpful insights, David. It seems like a lot of these pitfalls can be avoided with the right planning and awareness.
Absolutely. The key is to spot those red flags early and to proactively address them before they become significant issues.
So if someone is already in retirement and sees some of these red flags, what can they do to recover or avoid further issues?
Well, the first step is to reassess their financial situation. Look at income sources, expenses, and plan for any potential healthcare needs. It's also worth considering adjusting their investment strategy if they become too conservative.
And seeking professional advice can really make a difference, right?
Definitely. A financial advisor can help create a more tailored plan that considers their unique circumstances and goals. It's about being proactive and making adjustments as needed.
That's a great takeaway. It's all about being informed and adjusting your plan as life evolves.
Exactly. And remember, it's never too late to make changes that can lead to a more secure retirement.
Such great advice, David. Thank you for sharing these insights.
My pleasure, Emily.
And for our listeners, don't forget to evaluate your retirement strategy regularly and stay informed.
Absolutely.
Let's transition to how our listeners can take the next steps with their retirement plans.
Yes, let's dive into what they can do to ensure their retirement stays on track. All right, Emily. Now that we've talked about generating cash flow from commercial real estate, let's shift gears a bit and focus on actionable steps, things listeners can implement right now.
Absolutely, David. I think a lot of people might feel overwhelmed, but, it's really about taking one step at a time, right?
Exactly. So one of the first things I recommend is to review your current financial situation, and that means looking at your overall portfolio. You could set a goal to do this quarterly. It doesn't have to be a huge time commitment, just a few hours to assess where you stand.
Right, and that can help you see if your current investments align with your retirement goals. What tools do you suggest for that?
Well, there are some fantastic online calculators out there. Websites like Vanguard, Fidelity, and Schwab offer retirement calculators that can help you project your retirement income based on your current savings and potential cash flow from investments.
And those calculators are pretty user-friendly, right? You don't need to be a financial expert to use them.
Exactly. Just plug in your numbers and you'll get a clearer picture. Another useful resource is ssa.gov, where you can check your Social Security benefits. It's crucial to know what you can expect from that.
That's a great point. Social Security can be a significant part of cash flow in retirement. What about tax considerations?
Oh, definitely. Understanding your tax situation is vital, especially with real estate investments. Using tax software can simplify this process. Programs like TurboTax or H&R Block can guide you through the nuances and ensure you're optimizing deductions.
And if you're feeling really ambitious, hiring a tax advisor could be worthwhile, especially when you're navigating rental income and potential capital gains.
Absolutely, Emily. And for those looking to deepen their understanding of retirement planning, I'd suggest checking out some books. The Simple Path to Wealth by J.L. Collins is a great read. It simplifies investing and emphasizes building wealth for retirement.
I love that book. It's so accessible. Any other recommendations?
Sure. Your Money or Your Life by Vicki Robin and Joe Dominguez is another classic. It really helps you rethink your relationship with money and spending.
And there are also some great podcasts out there. I mean, aside from ours, of course. Laughs,
right? But seriously, the Bigger Pockets podcast focuses on real estate investing and could provide some valuable insights for listeners looking to get into commercial properties.
That sounds like a fun one. Now, switching gears a bit, what small habits can people start incorporating into their daily or weekly routines?
One simple habit is running regular retirement projections. Just set aside a little time each month, maybe even just half an hour, to check in on your goals and see if you're on track.
That's a manageable commitment for most people. And what about networking?
Absolutely. Building a network in real estate can be incredibly beneficial. Attend local meetups or join online forums. Connecting with others can provide insights and opportunities you might not find on your own.
That's a good point. Also, keeping an eye on market trends can give you an edge.
Yes, subscribing to newsletters or following real estate blogs can help you stay informed about changes in the market. It's never too late to improve your plan.
So true. And if listeners are already invested in commercial real estate, maybe they should consider revisiting their properties. Are they performing as expected?
Exactly. A quick evaluation can tell you if it's time to hold, sell, or even reinvest in something more lucrative.
And speaking of evaluations, what about considering a financial planner?
That's a great idea. A financial planner can provide personalized advice tailored to your specific situation. Just make sure to find someone who understands both retirement planning and real estate investments.
Definitely. And of course, having a plan in place for your cash flow needs is essential, especially as you transition into retirement.
Right. So with these tools and strategies in your pocket, you're better equipped to strengthen your retirement plan.
And it really highlights how proactive planning can lead to a more secure and fulfilling retirement.
Exactly, Emily. So let's recap what we've covered today. Well, Emily, as we wrap up this episode, let's summarize some key takeaways from our discussion on generating cash flow from commercial real estate.
Absolutely, David. I think one of the big points is how crucial it is to understand the different types of commercial properties, like retail, office spaces, or industrial. Each has its own cash flow potential, right?
Exactly. And the second takeaway would be the importance of due diligence. You really need to research and analyze market conditions and the property's financial performance before jumping in.
Right. And don't forget about the financing options. Understanding how to leverage loans or partnerships can really make a difference in maximizing cash flow.
Yes, and let's not overlook the value of having a solid management plan. Proper property management can enhance tenant satisfaction and, in turn, boost your cash flow. It's all interconnected.
For sure. And I think the last key point is to always consider the long-term perspective. Real estate can be a fantastic way to build and protect your retirement wealth over time, but it requires patience and strategy.
Well said, Emily. Building that wealth is not just about immediate returns, but ensuring stability for the future.
And remember, listeners, it's important to take action. If you found value in this episode, please like, subscribe, and comment your biggest takeaway, or even any questions you might have. It really helps us reach more people who are planning for or already in retirement.
And don't forget to share this episode with someone you think could benefit from it.
Next time, we'll dive into how Social Security earnings limits work, which is such an important topic for anyone navigating retirement benefits.
Absolutely. We'll help you understand how those limits can impact your overall retirement strategy.
Thanks for joining us today, and we hope you feel a little more empowered in your retirement planning.
Take care, everyone.
See you next time.